Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Tesla said it's moving forward with its robotaxi and affordable vehicle plans while reporting second quarter earnings that fell short of Wall Street's estimates. Adjusted earnings, 40 cents per share. That was just below the average analyst estimate. Revenue fell 12% to $22.5 billion. That was also lower than expectations and the sharpest decline in at least a decade. Gross margin, which is a measure of profitability, was higher than anticipated. Right now, shares down about 0.6%. Tesla did say many of its key initiatives remain on track, quote, despite a sustained uncertain macroeconomic environment resulting from shifting tariffs, unclear impacts, and changes to fiscal policy and political sentiment. Let's bring in Bloomberg Intelligence Global Autos and Industrials Research Manager Steve Mann, joining us once again from New Jersey. You gave us a great preview earlier in the afternoon. Now we have the numbers. Anything surprise you?
Yeah, I think if you look at the stocks down after hours a bit, I think the most important thing there is they haven't given us enough visibility into the future, what their outlook is going to be. I mean, the numbers, they miss consensus, but if you kind of dig into a little bit more and look under the cover, it's actually not bad. If you look at automotive gross margin, excluding credits, is actually 15%, better than last quarter of 12.5% and better than consensus estimates. And then if you look at free cash flow, the reason why it's down versus the first quarter is because they spent an extra $900 million on CapEx, which is not a bad thing given that they're launching the cheaper model and the cyber cap. So if you exclude that $900 million of additional CapEx, their free cash flow is actually over $1 billion, more than $660 million in the first quarter.
So that's good?
That's good. I mean, spending CapEx, given what their product launches are, is not a bad thing. They're investing into the future.
Right.
And look, they're also expanding internationally, right? They have, we've seen over the quarter improvement, higher sales in South Korea. They announced entry into India, and then they're launching the extended version of the Model Y in China. So it's a good thing. But look, we do want to hear what Elon Musk has to say in terms of not just the robotaxi, but how are they going to face the headwind, the challenges we're seeing in the U.S. market, which is critical. It's one of the largest market in their portfolio. So we'll have to hear more on the call.
How do you think Tesla's robotaxi stands up to the other autonomous vehicle solutions that are out there right now, namely Waymo?
Well, I think the market can be very big, especially in the U.S. If we're not talking internationally, there's definitely room for multiple players. My perspective is that Tesla's using an all-camera system. That actually gives them a greater flexibility and greater scalability with that system. Waymo and others use a combination of radars, lidars, and camera system. Cameras are just cheaper, right, to build, and and so it's a lot easier to scale, cheaper to scale for Tesla. So, but then again, I think the market's big enough. I think there's going to be users that want an all-camera system. I think there's going to be users that don't feel comfortable with that and want the redundancy of lidars. So, for example, Uber is partnering with Waymo.
So I got to go back to All right. So I'm looking at the FA function on the Bloomberg, and we just talked about free cash flow, and So it's $146 million versus $664 million in the first quarter of 2025, right, as our live blog says, dropping 89%. And I know what you're saying about it's good that they're spending for the future, right? Because you said to us earlier that the best way to get to that 1.56 million unit delivery for the year, right? That's a consensus estimate, is that they've got to launch that cheaper vehicle, right? So they've got to bring stuff out. Do we have to be worried, though, about that low number, or they're going to be fine?
Well, it's it's technical, right? It's that if free cash flow is over $1 billion, obviously the more the better. It is down.
Yeah.
Compared to a year ago, 2 years ago. But look, like if you look at the Model Y, if you look at the gross margin, excluding credits, it is up, right? That actually tells you that the new vehicle is likely, new Model Y is likely they're able to build it at a lower cost. The issue is, like I said in the preview, is they just don't have enough volume. Yeah. So if they can expand volume with the existing Model Y, not just in the U.S. but in the international markets, and as well as introduce the cheaper model, which is supposed to be built within the existing capacity, there could be a lot of upside, right? In terms of margin, in terms of free cash flow. So, it's really execution at the moment, and that's what we want to hear from Elon Musk. Where is the cheaper model? They said the production has started, initial production has started in June, but it could take some time, right, before they launch. They have to get all the kinks out. But you want to hear about India. India is a huge market, right? And where are they taking India? Definitely robotaxi is important, and then the cybercab. We need a little bit more details.
All right, details is certainly
near-term details. Near-term details.
Near-term details. All right, great setup. Right. Steve Mann, thank you so much. We're going to look forward to reading your research in the after hours and certainly into tomorrow's trade. Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Manager, joining us from BI headquarters in Princeton, New Jersey.
I want to go right now and bring in Ross Gerber. He's president and CEO of Gerber Kawasaki Wealth and Investment Management. As of the end of last year, had about $3.4 billion in assets under management. Long-time outspoken Tesla bull, more recently expressing concerns about the company, as he did 3 months ago after the last quarter earnings report. According to the Bloomberg terminal, Gerber Kawasaki still owns about $78 million worth of Tesla stock. Ross, good to have you with us this afternoon. What have you been doing to your Tesla position over the last quarter? Just before we get your take on the numbers.
We've been selling for years, and I continue to sell. We have so much stock, and we have a lot of clients that really believe in the Tesla story, and we've kept some stock, obviously, in our portfolios. But in my ETF, I'm out of Tesla completely, out of my GK ETF, and it's mostly because the business is declining, and these earnings results continue to show that the business continues to decline, and in some kind of troubling ways. So as much as the previous guest is bullish on many of these things that Elon talks about, nobody wants to talk about the truth that nobody wants to buy Elon's products. Like, until that gets addressed, there's a huge elephant in the room that nobody seems to want to point at, because it's Elon. And so he's the innovator behind all of the things that are great about Tesla, but he's also the sort of villain that's created so much animosity around him that nobody wants to buy his products.
We've got a great cover story by the team of Max Chafkin and Ed Ludlow in Bloomberg Businessweek, the new issue coming out, the August issue. It'll soon be on newsstands. It's already on the Bloomberg. But, the whole idea, Ross, as you know, since you understand this company so well, you never kind of count Elon out. And so I do wonder, if he does get it right, if he maybe, I don't know, we'll see what happens in terms of his involvement in politics, because it does seem like he still wants to stay, according to the SpaceX filing. But I mean, there is always that caveat when it comes to Elon, right? That he sometimes pulls it out, or he often pulls it out.
Yeah, and I think that's been true in the past, and I'm very grateful that he pulled it out 5 years ago when it really mattered, and Tesla was almost on the verge of bankruptcy, and it has become a very successful company. But it doesn't mean he's going to do it again. And this idea that these kind of entrepreneur rock star people don't fall is actually is not true. In fact, it's very common to what we call the rise and fall story. That's all the stories you see on Netflix and the documentaries. So, this might be a rise and fall story, and things don't rise forever per se. And I always remind people, I don't think most people even know who invented the television, but the television was invented in the United States by a company called RCA, which was like the hottest stock of the 50s. Mm-hmm. Well, how many TVs are made in the United States today? And the answer is 0. So the very same thing could happen in the EV business. But that said, Elon can fix the company. It's solely broken because of him. He can certainly fix the company if he wants to do what's necessary to improve his image. And in a year, people forget, and Tesla might be back. But he just doesn't seem to care about fixing his image, and he doesn't seem to be in understanding the responsibility goes to him on why sales are down so much.
So why even have any Tesla stock right now?
I think the reason I hold personally still some Tesla stock is for the same hope that we all have, that they are definitely focused on a future, and especially for me, a climate activist. It's a green future that I'm pushing, and Tesla still is the leader in green, transportation and energy, and I think it's an incredibly important company to succeed. Hence why I'm out here banging on Elon all the time. It's not, for any other reason than wanting to see Tesla succeed, because it's crucially important to climate change. But this robotaxi business is not crucially important to anybody. So, I think Tesla's main business is selling EVs and energy storage, and they should be focused on repairing that main business. And I think their other future endeavors are interesting, and that's why it's a reason to hold the stock. But it also trades at 150 times earnings that are going down.
Okay.
And so, you have to weigh that too.
In the past, you've talked about how nice it is to drive a Rivian, for example. Are you willing to now invest in any other EV company that you've turned on Tesla?
No, I've lost a lot of money in EV businesses over the last 5 years that I've hoped would succeed, including Rivian and many others. And unfortunately, many of the EV operators are now having all the incentives taken away from them, as well as traditional car companies, along with tariffs and everything else. It's just really a horrible setup to be a car company. The car company we own is Ferrari, actually, which has no problem selling their cars at 40% margins that make Tesla look like chump change. So, truthfully, it's just a tough to be in a global auto business on a great day, let alone with Trump as president. So it's a very tough time for the businesses, and I'm just not recommending that right now, versus a stock like Train Technology that makes, clean energy air conditioning units, where the demand for air conditioning is off the charts. And that's been a wonderful green energy investment, along with GE Vernova, right, which we also own. Well, that's been a wonderful green energy investment, but it's not EVs.
Hey, listen, I do want to go back to, we've got the Tesla Live blog going on, and just tracking everything that's coming out of the earnings. Ardana Hull, who covers Tesla and Elon, says page 12 of the shareholder deck shows the Tesla ecosystem, which includes Optimus, we know the robot, pushing a baby stroller. Ross, when it comes to Tesla and the world of Elon, there are so many different moving parts. There's, the shining beacon of SpaceX, right? That's a really great business. There's all the AI stuff that's going on. There's so many different moving pieces. What else do you want to know, maybe on the call today, about, from the Elon universe?
Well, I think the most important thing in my mind that has the biggest opportunity to help Tesla is this low-cost vehicle they keep talking about. They have so much excess capacity in their factories now because they're not selling more cars, that they need a new vehicle. And also for addressing other markets, whether it be India, China, and Europe, you need a small vehicle that's inexpensive to compete against the other EV players and regular traditional car companies. And they need to do this now. And the sooner they do this, the better. And that's the most important thing. I know we like to talk about the day a robot is pushing my kid around in a stroller, but that day is long in the tooth from coming, nor does anybody in the world would trust some big robot made by Elon Musk.
Yeah,
so I think we need to get out of that fantasy, you know?
Well, I was just going to say, when I'm on my deathbed, I know I'm not going to say, I wish I spent less time pushing my kid's stroller and had robots do it instead. It's the dishes I want done, not less time with my kids.
The laundry done.
Yeah, the dishes.
But I don't have
my
12
wife
kids,
actually
so
likes doing the dishes, so I don't know.
Tell her, ask her what her secret is. I would love to know. Hey, Ross.
I don't know. She likes it. I don't know.
Ross Gerber, always appreciate you finding time for us. We got to run. Right now, shares of Tesla just down about 0.6%.
You're listening to the Bloomberg Business Week Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
We do want to bring in to the conversation Brent Thill. He's Senior Technology Research Analyst at Jefferies. He's got a buy rating on Alphabet. He's got a hold rating on IBM, which also is out with their results. And we are seeing that stock, let me just bring it up real quickly on the Bloomberg, shares of IBM are down about 4.4%. So we're both seeing some movement there. And right now, Alphabet down 1.2%. Hey, Brent, good to have you here into the conversation with Tim Mandeep and myself. Your take on what we got from Alphabet.
Yeah, I mean, it was pretty in line. I don't think there was any big fireworks. You had a bigger CapEx number, was about $4.5 billion higher, which is a sign of investing in AI. They raised CapEx by $10 billion, which again, everyone knows it's going to AI. And so I think everyone likes that they're spending to keep pace, but obviously it's having a drag on the margin. So the margin last quarter was about 40%. They're at 38.3%. So a little bit of a drag on the margin on the downside. And then, just magnitude of upside, just, not a lot. And they don't give you a lot of color what they're doing. So I think, look, this has been the worst sentiment of any name I cover in internet. Our investors are not bought in. Everyone's starting their search with ChatGPT and Perplexity first, but you still end up in Google. And so the big question is ultimately, where are they going to end up in this AI race? And many of the advertisers are talking about a transition with AI overview and what they're going through, that it's more expensive and they're getting a better impact from it, but it's still early. So overall cloud, did well. YouTube was 13% growth. It was 10 last quarter, so accelerated a bit off an easy comp. And so, yeah, I think it's just basic kind of quarter, nothing really exciting. The challenge right now is investors just don't believe. Any investor I talk to is like, I need to be underweight Google because I just don't believe they're going to make this transition.
Well, make the case for us. Make the case for us that you think they will make the transition.
Well, the case for the transition is that you need three things for AI. You need data, users, and capital. And they have more data and more users than anyone in the world. So if you, I've always said this, I think this is like pulling up to a stoplight and you look right, and it's like a tiny little car, and you might be in a car that you think is faster, and then the car on the right just takes off, and you're like, wow, I didn't realize that was underneath the hood. Or where did the muscle come from there? They have a lot more AI muscle under the hood than they're showing. They're terrible communicators. They're not good with investors. They don't give you guidance. They don't go on the road. They don't spend time with investors like NVIDIA, like Microsoft, like the rest. And so investors are just like, look, they give me the earnings call 4 times a year, and that's about it. And then the filing, and that there's nothing in it, and then I'm left to guess. So every investor has to do their own work, and we're all doing our own work. Your day starts in ChatGPT and Perplexity. It's not, and it was starting in Google maybe a year ago. There's alternatives. So I think this is the same thing we're seeing with Adobe, with Salesforce, other names we cover in tech. Is a new crop of AI stories going to effectively not necessarily replace, but become the central spot where you start your search? And I don't think that that boogeyman's going to go away for a while. So again, I think stocks underperformed. It's done nothing. You look at the IGV, the software index, it's up 12%. Google's flat. You look at the other index, the SMH, the internet index, you're up 18% year to date. Google's flat. I mean, there's literally been way better ways to make money, whether it's DoorDash, when you look at what's going on in Meta. And we hear this from advertisers. Advertisers are obsessed with what Meta is doing in AI. And so, again, I'm not super bearish on Google, but I think what we're seeing are the facts of the facts, which is it's really hard to change the narrative, and they're going to have to make a change in their own behavior and the numbers and then the adoption rate. And so that, again, we're never going to rule them out. I think the stock's super cheap, so that's why I still have a buy in it. But I would say of all the large cap internet names, they have the most work to do.
All right. So Mandeep, come on back in. Our own Mandeep Singh, Global Head of Technology Research at our in-house Bloomberg Intelligence team. I mean, do you think that they could do better in terms of messaging? I'm curious about your thinking.
I agree with Brent on that they are the ones who give you the least when it comes to the product pipeline and how it's going to change their business, especially given they are getting disrupted. So they could do more. But at the same time, like I said, a search business that is their cash cow growing double digit is a very impressive performance. And to my mind, given all the competitive threat that we talk about, they're still able to execute. And unless the search business really starts to decelerate sharply, I don't see anything in the fundamentals that has changed for Google.
Is Meta a threat to Alphabet?
No, because they're struggling with their own large language model. That's why they're making all the acqui-hires. So they don't have the talent. It's really Google and OpenAI that are going neck and neck when it comes to the consumer side. And then you have got Anthropic on the enterprise side. But these three dominate the large language model race right now.
Let me add that the advertisers are not saying that. Our advertisers are saying they're shifting dollars to Meta away from Google. So I think when you look at actually advertising dollars, they are shifting, and that's coming from our checks. So I think that there is a shift that's been happening. I don't think Google goes to zero, but I do think there's a shift in advertiser spend.
Why did Google search then grow double digits this quarter?
It's starting to fade, and we think that ultimately Meta's results are much stronger.
Okay, I mean, that's where we have to wait for Meta. Maybe it grows high teens or over 20%, and then probably
Meta stock's up 22% year to date for a reason, because the advertiser checks that we all do are saying that secondarily, the framework of what they can do with AI is so much more powerful from what we're seeing in the experiences. So I'm not a Google hater. I just think that we're starting to see a sudden.
But they are behind when it comes to LLMs. So it's not because of their LLM lead that their ad revenue is shifting. So it's just better ad surface and how Meta is monetizing. It's not because of LLMs, right?
I don't believe it's because of LLMs, no.
Yeah.
So Brent, if indeed there is this shift happening, and I certainly see it in my behavior, and I do end up going back to Google, but there are other options out there now, whereas there used to not be other options. If that happens, how does Google end up leveraging its AI product for actual ad revenue? What does that look like?
Well, I think the challenge is when you go back to Gemini, that if you've gone into Perplexity into the app or ChatGPT, where we all started and Gemini was late, how do you transition out of those apps when they're already front and center? And so they've got to get people to kind of get out of that. And then secondarily, like I go back to I planned a family vacation in Europe on ChatGPT. And to your point, I had to go back to Google to find the boat rental, the restaurants, all the things we want to do as a family. So I do think that you ultimately end up back. I think that the challenge right now is it's unclear exactly how they're going to navigate through this, and are they going to end up in a better or worse position? And right now, Wall Street's betting a worse position, right? Stock's down on this print, which wasn't that bad. Why is it down? Why is the sentiment so bad? There's just better alternatives that people see, and you hear these advertisers, these big advertisers are spending billions of dollars a year on behalf of their clients, and they're saying, well, this is what I'm doing with my ad budget. So I think they need to do a better job of you've got to get AI overview in the market and get usage. You have to effectively show a better ROI. You have to get Gemini usage up. I think, from a Wall Street, a lot of this is just actually management too, which is giving conviction. We covered Microsoft when Ballmer was there, and stock did nothing, and people just didn't have a conviction. They had conviction when Nadella came in, the stock went from 30 to now it's 500. And so a lot of this too is optical. You got to optically hold hands and help people, because investors get the help from a lot of the other companies. They don't get the help from Google. So if you can drive a car, you're probably more likely to buy it. But if you can't drive it, then like maybe I'll just go buy another car I know I can drive. So they need to do a better job on that side.
And to Brent's point about Gemini usage, I think on the call, if they share the token count, so last quarter they mentioned 480 trillion was the token count, and it grew almost 5x month over month.
Right.
Microsoft shared a similar metric. And to my mind, in the case of Alphabet, you'd not only have the cloud lift, so cloud consumption is driving token count, but also the surface area they have with their family of apps. So they have 6 apps with over 2 billion monthly active users. All the AI, Gemini AI that they are deploying on those apps, including search, that will show up in the token count. And that's why Google is almost 10 times that of Microsoft. So Microsoft processed 50 trillion tokens.
Right.
Google processed 480 trillion tokens. That's because of the surface area they have to, show Gemini and deploy that. And that, for me, is a key metric on the earnings call.
So that's what you're going to be looking for. All right. We're going to let you go because you, I know, have lots to do. Mandeep Singh, you are such a gem, Bloomberg Intelligence. Hey, Brent, before you go, just a quick thought on IBM, because they also report and they're down almost 5% in the aftermarket. What do we need to know just quickly?
Yeah, software did better. Consulting's kind of like blah. And I think the CEO had mentioned they'd like to do better in consulting, but that's seems to be the biggest concern across consulting overall. So, tale of two cities, software business growing high single digit, consulting not massive grower and flat on a constant currency basis. And so, they're shifting to become a software company. Arvind has done a great job, the CEO. The stock's up almost 30% year to date. The multiple's almost at Microsoft. Like, I'd much rather own Microsoft. I'd much rather own Google. There's other names I'd rather personally own. I can't own any of these names, but we're advising our clients to own over IBM. We just see, the stock pretty full at the multiple it's at.
All right. Just real quickly, what would be your top number one question on Alphabet on the call here? And the stock's down still 1.6% lower. Just quickly.
The continued adoption of AI overview and what's happening with Gemini.
All right. Going to leave it there. This was fun. Brent, thank you so much. Brent Thill, he's Senior Technology Research Analyst over at Jefferies, joining us on Zoom on this Wednesday.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So we've seen initial public offerings definitely picking up some momentum this year. As a group, IPOs are up about 5% year to date as measured by the Renaissance IPO index, but up 41% from a low back on April 8th. We've got a couple of IPOs today. Both are trading lower in their first day of trading. We've got NIQ Global Intelligence shares slumping after the company raised more than $1 billion in its IPO, giving it, Tim, just about a market cap of just under about $6 billion.
A small cap, Carlsmed. It's a med tech company slipping in its first day of trading after it raised $100.5 million in its IPO. The company with an approximately $387 million market cap. Carlsmed uses AI to personalize spine surgery. It sold 6.7 million shares after offering them for $14 to $16 each. Here with more on the company in the first day of trading as a public company, Mike Cordonnier, co-founder and CEO and president of Carlsmed. From the NASDAQ, also joining us, Bloomberg News equities reporter Natalia Konijevic. She's here in the studio with us. Mike, the stock is down on the first day. How are you feeling on a day such as today? Stock not necessarily moving in the direction you want to see?
Well, we're feeling really good about, how we're doing today. Continue to focus on our mission and building awareness about, really what we do that ultimately we know has transformed spine surgery. And so, continue to focus on the fundamentals and, it's ultimately going to be a really strong day for us.
For those who might not be familiar, Mike, just fill us in on exactly what you do. From what we understand, you guys do personalized surgery, which got one of our producers, Cece, a little worried because we thought all surgery was personalized. At least we hope that's the case when we go under the knife, so they say. So what exactly do you guys do?
Yeah, we've really taken a very different approach to what really a medical device company is. And so we are a medical technology company, and we work with surgeons and patients, and we take digital imaging of the patients as well as surgical inputs from the surgeon, create a virtual plan of that patient's surgery, and then we 3D print personalized devices for their spine surgery, build those on demand, delivered directly to the operating room. And ultimately what this does is this gives the surgeon really power to be able to perform very precisely what can be a really complex spinal surgery.
Mike, hi, congratulations on trading debut. I'm curious about your path to profitability, because companies like yours typically require a lot of CapEx. Do you guys have any timeline in mind on when you become profitable?
Yeah, well, we haven't provided direct guidance to that. However, we have built our company very differently than a traditional medical technology company because we don't carry any inventory. Everything that we create is 3D printed directly on demand. And so as we think about this public offering, the use of capital to reinvest towards really our growth in being able to provide this technology to a lot more patients.
What's proprietary?
Yeah, ultimately, we have a broad technology platform that we built. And so as we think about rolling this out much more broadly, we've been able to create an end-to-end technology platform that is proprietary to us, that we've called our digital production system. And this is a all-in-one system that allows us to take digital data about the patient, about the surgeon, create personalized plans and the devices to achieve those plans. And ultimately, when we started down this journey just a few years ago, this whole end-to-end process took us a little bit longer than 8 weeks. And now we've really reinvested in our proprietary system that allows us to do this in 2 weeks or less, which really allows these scheduled surgeries to be able to be done in the time that the surgeon and patient needs them.
Mike, why was an IPO the right move here? If the broad adoption by doctors around the US and around the world is your goal here, why not look to be acquired by, let's say, a Medtronic or a Johnson & Johnson or a Stryker that already has these relationships with doctors and can roll this out more broadly?
Yeah, we really think about this much more than a product line, and really much more as a new way to run a business, because very different than what the large players in this space do, which tends to be a very capital intensive business model. We've built this new business model, which is really digital first, allows us in conjunction with the surgeon to do the procedure digitally first, and then make on demand everything that's needed. And so because of this, because of ultimately our ability to do this on demand, we've built a very nimble, agile company that we can deeply target those key institutions and the patient population to directly deliver exactly what's needed. And we see this really as a platform technology that has a lot more applications, much beyond our current indications that we have for spinal fusion.
So can I just ask you, so does that mean you ultimately see yourself maybe for every complicated surgery figuring out how to do this? Just quickly.
Yeah, absolutely. We see this as continued innovation, partnership with surgeons, as well as us on the technology side, to be able to provide a very novel, personalized solution to patients that ultimately drives better outcomes. Because as we've looked at our early data for spine fusion surgery, we've been able to materially improve outcomes for patients because we can directly personalize the devices needed for their surgery.
Mike, what is your tariff exposure?
Yeah, so we are 100% supply chain in the U.S., and so we're very well insulated from the news that's coming out around tariffs.
Hey, one thing I want to ask you though, in terms of the growth of the business, I know you're not going to give us anything on profitability or when you get there, but what's the growth that you are seeing in usage, growth in revenues? Can you give us some numbers? We are Bloomberg and you are public now, and ultimately you're going to be sharing this stuff. Just got about 40 seconds.
Yeah, absolutely. We've grown phenomenally since we started, and we can report that in the first quarter of this year, we grew 100% year over year, and so we see this adoption very rapid with new surgeons, new accounts coming on board, and we anticipate continued wide adoption of this new standard of care.
All right, I think we have to leave it there. Hey, listen, stay in touch. Love to know as you continue along, and maybe on that first earnings, you can come join us after that. Mike Cordonier, he is co-founder, co-founder, CEO and president of Carl's Med, joining us from the NASDAQ on their first day of trading. And our own Natalia Kedijevic, she's here in studio. She's our Bloomberg News equities reporter.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Those latest trade agreements still waiting to be done, including one with the EU, and then another that's already been hammered out with Japan, Tim.
Weighing in, both U.S. Treasury Secretary Scott Bessent, followed by U.S. Commerce Secretary Howard Lutnick.
15% for Japan for reciprocal tariffs for autos. That is a different kind of deal, but because the Japanese proposed a very innovative solution.
Has Brussels come up with anything innovative?
Not yet. The EU has a collective action problem. 27 countries.
That's up to them to negotiate, right? Are they willing to open their market? I don't think anybody. Europe's not going to go and give us $1 trillion to.
Well, can they get below 15%, or is 15% now the floor?
For autos, I would.
No, for a reciprocal tariff for the European Union.
I don't think
at one point they were willing to accept.
I don't think
10%.
big countries can get low like that.
All right, that, of course, is U.S. Commerce Secretary Howard Lutnick, preceded there by U.S. Treasury Secretary Scott Bessent. They were earlier on Bloomberg Surveillance on TV and radio. Hey, check out those full interviews. You can find them on the Bloomberg and at Bloomberg.com. Hey, for the tell, though, on these trade agreements and what impact it may have on global trade and for investments in the U.S., we start in the nation's capital with a senior advisor in Japan chair at CSIS. It's the Center for Strategic and International Studies, Christy Gavella, joining Tim and myself from the nation's capital. Christy, it does seem like things are moving along on trade deals. According to what's kind of coming out, are these good trade deals for the United States? Are they good for the economy? Are they good for the global economy? And why or why not?
Well, it certainly seems that the Trump administration is gaining momentum in its quest to negotiate trade deals before the August 1 deadline. If we look at the deal that was announced with Japan yesterday, it's clear that these are good deals for the U.S. in the sense that the U.S. is raising tariffs by significant amounts, and therefore administration also by getting increased investment that addresses the trade deficit. Some could argue that the concessions being offered are perhaps not as significant as they might have wanted, but they are getting, for example, Japan $550 billion in investments, as well as concessions on rice imports and also on auto safety standards. So these are meaningful deals in a sense. And the deal with Japan was the most substantial negotiated yet in terms of trade volume.
In your view, does it seem like the deal with Japan is better for Japan or better for the United States?
It represents a compromise on both sides. Japan's initial position was that it wanted the removal of all U.S. tariffs, which, of course, it did not receive. But a key issue for Japan was the tariffs on automobiles, which were at 25% from earlier in the year. So Japan received a reduction to 15% on autos and also received an overall reduction from the proposed 25% reciprocal tariffs to 15%. So that is a substantial improvement over the initial conditions Japan was facing. It's also the lowest reciprocal tariff rate that's been negotiated to date with a country that's running a trade surplus with the U.S. But make no mistake, 15% tariffs are still a significant blow for the Japanese economy. So, things were given and things were gained on both sides.
Hey, there was a Bloomberg story, Christy, out this morning. It included a quote from Trin Yuen, senior economist for emerging Asia at Natixis. And she said, we live in a new normal where 10% is the new zero. And so 15% and 20% doesn't seem so bad if everyone else got it. And she's talking, of course, about tariff levels. She went on to say that a 15 to 20% tariff level, it's still profitable for U.S. companies to import from abroad rather than produce similar goods at home. So wait a minute. I thought these trade deals were about bringing back manufacturing and supply chains to the U.S. and investment back to the U.S. Is that going to really happen?
Well, on your initial point, it is true that the Trump administration has managed to reset people's perspectives on what constitutes reasonable tariffs. So, what we see with Japan, for example, would have been considered horrific, and the minimum 10% that seems to be on the table is also shocking by previous standards. But it is true that in the longer term, it's still up in the air whether these tariffs will really achieve the goal of bringing investment and jobs back to the U.S. in a substantial way. These tariffs are not necessarily the best tools to do that, and it also is very difficult to predict how companies and others will react to them. So we can only really see the short-term consequences in terms of rising prices for consumers and also the revenue that it will generate in the short term. But companies and others will adjust in unpredictable ways, and it won't necessarily mean that they will come back to the U.S.
The president has talked about trade deals and economies opening up to the United States. In your view, was the Japanese economy closed to the United States? I mean, certainly from an automaker perspective, it's been a few years since I've been in Japan, but I didn't see any American cars on the roads of Japan. They were all Japanese cars there. But has the market been closed to the U.S.?
In general, tariff barriers in Japan are not significant. Japan has had open trade with the U.S. for a long time. But you're correct that on sensitive products like agriculture, there have always been high tariffs. That's not unique to Japan. So rice did become a significant issue in the negotiations. On autos, the main issue there is more complicated. So the concession that was given in the agreement related to auto safety standards, which have long been perceived to be a non-tariff barrier that have made it more difficult for U.S. automakers to sell in Japan because they have to meet different safety standards. But there are a host of market factors that make U.S. cars less competitive in Japan that won't necessarily be addressed by these changes. So, there are areas, in short, where Japan's market has been rather closed. But on the whole, companies face relatively open conditions on a relatively free and fair playing field.
We've seen some reports about the EU seem to be maybe working, getting closer to a deal with the United States. We've got China next week. Just to wrap up, just remind everyone why having trade deals with these big trading partners is important for the U.S. economy and the U.S. overall.
Well, from the perspective of the Trump administration, the issue is that these countries are running trade surpluses, so they are seen as a negotiating tool in that sense. Overall, these are our major trading partners in the U.S., and so the trade volumes that are going through are significant to the economy. It's important that these relationships are maintained. It's important that, from the administration's perspective, they be rebalanced in various ways. So, getting these deals ahead of the August 1 deadline minimizes disruptions to markets and to companies' activities. So it's important that they move forward.
Yep, we can cross a big uncertainty off our list here, no doubt about it. Thank you so much. Christy Gavella, Senior Advisor and Japan Chair at CSIS, the Center for Strategic and International Studies, joining us from the nation's capital.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.